Welcome to Easier Accounting for All. This course was created based on several years of my professional experience. I am an accountant and I have over 30 years of experience. It is designed for people with no prior accounting knowledge. It's ideal for small business owners who want to understand their business performance using financial data. We know that most of the small business start operations without any accounting system, so this is going to be very well for you. It is helpful for beginner accounting students. If you plan to start accounting classes, I highly recommend you to watch these videos. It is also appropriate for individuals seeking for a job as a bookkeeper. Bookkeeping is one of the most important inputs that we have in accounting because that's the original record of when you record the transactions into the system. This part of the course does not cover computerized accounting systems. However, you will understand how computerized accounting system process the data. Yeah, definitely, because we are going to do most of the things in Excel, so you're going to understand how the things move around, and that's exactly what the computerized accounting systems are doing. The course is presented in a step-by-step format. Please make sure to watch all the 4 videos. This part of the course is going to be 4 videos. If you are one of these, you are in the right place. The content of these videos is, the subjects are: what is accounting, the accounting cycle, the accounting equations, types of accounts, and nature of accounts. This is just a theory, but it's the concepts that are very important to understand as we move on into or navigate into the accounting process. So keep in mind these concepts, please. What is accounting? It's a logical process that helps you to track the business transactions originated from money that comes in. It can be from income, through sales, investor loans, customers. Money that goes out, purchased to vendors or from vendors or suppliers, utilities, home distribution, etc. Accounting helps you to see clearly if your business is making a profit, losing money, or just break even. If you don't have an accounting system, you don't know the accurate way what is your position here. It is basically an organized and logical system to produce financial information so you can make smart decisions. Accounting is like a compass. It guides your business, showing you where you are and helping you make the necessary changes or adjustments to stay on track and reach your goals. This is accounting is helping always to correct the directions to make or to get a goal that you are looking for. The accounting cycle. When you say accounting cycle, refer to something that is in circle, like this. So always the accounting cycle start with the transaction and go step by step until all is closed, that transaction is closed, and start with another transaction, and every single transaction is going to do this type of cycle or loop. So what is a cycle? It is a sequence of events or actions that repeat in the same order over and over again, creating a consistent loop. This is over and over again, creating a consistent loop. Okay? The accounting cycle is step by step, one by one. A process that businesses use to classify, and that happened here in transaction. Classified record, that happened here, journal entries, and summarize transaction during accounting period. The summarize is going to happen here in the financial statements. So you can do that monthly, quarterly, or yearly. That is to produce accurate financial statements. In this class or in this course, we are going to talk just about income statement and balance sheet. That shows you the financial position and performance of your business. So when I say financial position, we are talking about balance sheet. When we say performance of the business, we are talking about income statement. The accounting cycle starts when the transaction happens, like here, like sales or purchases, etc., and ends when the books are closed and financial reports are prepared. So ends here and start again here. Okay, accounting cycle steps. The following are the things that you have to keep in mind when you start applying the accounting cycles. The first thing is identify and analyze all the source documents from each transaction. That's very important to classify and analyze, right? Every single document. Source document is the source means where the document coming from for each transaction. Record the transaction using journal entries. Yeah, after you have this classify, organize, make it like a batch by categories of everything, you start to record the transaction using journal entries. This is the first part, a very important part, because this is part of the bookkeeping. Somebody is going to start doing that one. Okay. So after you have that one, the journal entries, every single journal entry has more than one account, minimum 2, but it can be hundreds of accounts in the same journal entry. So every account, it may be a bit different. So when you have several accounts, all the single amount that you put in your general journal entry is going to be reflected in a general ledger. So it's going to be transferred to general ledger. So general ledger pretty much is the single account that show all the transactions that hit that account. We are going to see that one later on. Prepare a trial balance. After you go to the first 3 steps, you can just prepare a trial balance. What is a trial balance? It's just a list of accounts from the general ledger. So you just have the account name, the debit balances, and the credit balances for every single account, and it has to be with 100% of the account that you have in your books. So when you have that one thing that is critical, and it has to be like that always, is that the debit should be equal, total debit should be equal total credit. If not, something is wrong. The books are out of balance. So you have to start reviewing what's going on. That's why the trial balance is a tool to find out mistakes or to find out what is missing to process. If you find something that is missing, you have to make adjustments, entries as needed. So most of the times people just start to calculate depreciation, doing accruals that happened to before, probably amortize prepayments or prepaid expenses, post the bank fees, etc. So this is the time that you can just find out what is missing based on the trial balance. So after you do the adjustments, so now you have the prepared and adjusted trial balance. So you're going to have the adjusted trial balance after you do the adjustments. So in the adjusted trial balance, you have to verify again if something is missing or not. If something is still missing, you have to go back and make a journal entry. That journal entry is going to affect the general ledger. The general ledger is going to give you a trial balance, but this time it's going to skip to the adjusted trial balance again. But if everything looks right, looks reasonable and accurate, so you have to go to the next step, which is prepare financial statements. That means you're going to prepare the income statement and the balance sheet. Okay? So what I say, income statement first and balance sheet second, because from here you have to calculate if you have profit or you have loss or your business are break even, and that dollar amount that came out from here, it is going to be reflected in the balance sheet. So in other words, to complete the balance sheet, you have to have done the income statement. Closing entries. Usually, if you are working with a computerized system, they do like a logical, let's put like a random memory logical calculation to close the accounts. But it's not going to be physical in your hard drive or in your system. It is going to be just to present the financial statements. When they really close for the temporary account, that's what they call temporary account. The income statements has a temporary account. That means at some point, especially at the end of the year, December 31st, those temporary accounts, after they have huge balances or whatever balances, they became on zeros. They had to close and put in zeros to start the next period, the next year, with zero balance. The temporary accounts always start with the zero balance at the beginning of each accounting period. So keep in mind that is very important. The accounting equation. Let's see what is the accounting equation. The accounting equation is an equation that shows what a business owns, what it owes, and the value that belongs to the owners. The accounting equation should be always in balance. You know, it's a question, it's a math expression. So, and it's always an equal in between. So this is the accounting equation. The expression for the accounting equation is assets, which is from the balance sheet, equal liabilities, which is part of the balance sheet, plus owner's equity. Keep in mind these ones, okay? Assets equal liability plus owner's equity. These equations can be expressed in different ways, like this. Assets minus liabilities equal owner's equity, or liabilities equal assets minus owner's equity. All these are the same equivalent expression. The accounting equation names definition. So we have three things in accounting, right? The assets, the liabilities, and the owner's equity. Assets is what the business owns, like a cash, buildings, equipment, inventory, etc. Liabilities is what the business owes, loans, accounts payable, credit card, utilities, anything that they had to owe to the third parties, that's a liability. Owner's equity is what is left for the owners after paying all debts. So liabilities is calling also debts, okay? So, but it is most popular in financial statements, and debts is additional expressions. But technically it's assets minus liabilities equal owner's equity. In other words, you have everything after you pay what you owe. So this is what it is. The value in the accounting equation changes based on business activity or transactions. Every time that we start a new transaction, this equation is going to be changed. The values of this equation changes all the time, right? So this is very important. Examples of transactions that affect the accounting equation include sales, purchases, loan, investment, debt repayments, liability, ownership withdrawals, and non-operational income or expenses. It's more than that. This is just to mention a few, okay? Types of accounts. We have different accounts, different groups. But let's see, assets account, we already went through about this. This is part of the balance sheet accounts. Liabilities accounts, we already went through, okay, money that owes by the business. This is part of the balance sheet, keep in mind that one. Equity or capital or owner's equity that we already went through, that is what is left after substantial liabilities. These three groups are part, essential of the balance sheet. Now we have the income, which is money earned by the business and is created by the regular business operations. So this is one of the accounts from the income statement or profit and loss. Same way, cost of service or cost of goods, these are indispensable to produce the income, but it has a direct relation with this one. If you sell parts, you have to buy parts, so that's related. If you have your company sells services, probably you provide professional services in different areas, so your cost of service could be hours, it could be internet, it could be many other things, depending on the industry where you are moving. That you have to identify which one is going to be your cost. In other words, which one is going to be indispensable to produce the income. And we have the expenses that not necessarily are indispensable to create income, but sometimes it's needed to earn a revenue. But I can tell you one of the ones that are not necessary for this one, not necessary for income, like if I buy a pizza for some employees. That's not part of the cost. It is not necessary to produce income at certain points. There are some subdivisions related to this account that later we will talk about. Every single, this is like a group of accounts. Every group can have many accounts, and those accounts can have sub-accounts and so on. But at this point, we are talking about only the types of accounts, how they're going to be classified. Understanding the nature of accounts. The nature of account refers to its normal balance. I will want to say that when I say in normal balances, always the balance has to be positive, right? And how their balances increases or decreases. Now, there are exceptions, and I got to explain that one when the balance is negative. How could that happen? I got to tell you right now. Assets accounts. These accounts, the natural is a debit accounts. So that means that accounts increase, or those accounts increase with debits and decrease with credits. So all the time, my balance should be a debit balance. In other words, the debits should be higher than the credits, or the debits and the credits can be equal, so my balance is going to be zero. But if at some point you get a negative balance, it means that the credits total amount were higher than the debits amount, total amount. So keep in mind that one. So it should not be, but it has. One of the things that you're going to find out that this happened is especially when you do the trial balance. Because you say, okay, come on, how can the cash or my banks have credit? So something has to be adjusted, okay? Liabilities. These accounts increase with credits. This is the opposite of the assets. Increase with credits and decrease with debits. Same philosophy. If the balance it is negative, it means that the debits, the total debits are higher than the total credits. That should not be. So again, you have to find out why and make the necessary adjustments. Now, if the credits, the total credits equal total debits, your balance is going to be zero. And yeah, it's a lot of accounts that at some point should be zero. One of the examples why it should be zero, if you pay off any loan that the business received at some point, so your balance is going to be zero because the loan was credit, right? But your payments were debit. So after you pay in full the credits, your balance is going to be zero. But again, always the balances in each group should be positive. It is very common to think that people believe that debits are positive, credits negative. It happens, we can understand it that way, but not necessary, okay? But anyway, equity and earnest equity. These accounts increase with credits and decrease with debit. It applies the same description or same principle for liabilities accounts. Income and revenue. The nature of these accounts are credits. I will say that probably 99% of the transactions are reflected in credits, which let me tell you something about where is credit, where is debit. Usually there is something that is called T accounts that they are represented in a journal entries, general ledger, including the the balance sheet. It's a T accounts. So we are going to discuss that one about later on. But the left side of the T accounts are debits, are called debit, and the right side is called credits. So we are going to check those concepts later on in one of the exercises that we are going to do. So that's credit. So the cost of service or cost of goods, the naturally is debit, is the opposite that the income. So again, most of the transaction in a cost of goods, it should be debit, except for a few like the credit that may reduce the balance. We will receive some credits from our vendors. We buy inventory and they send us a credit because we pay early or because we return things. So that's going to be a credit journal entry to that account. Expenses. Expenses have the same concept as the cost of service. So they are debits, it should be debits all the time. There is another fraction of the account that we call in income. It could be other income, which should be credit too, or in expenses, other expenses, which should be a debit balances too. I hope you enjoyed this video. I really want you just to jump to the second video and continue to the last video, that is number 4, when we are going to complete the full cycle and get into the financial statements. So in my next video, I will talk about source documents, general journal entries, and the general ledger in a super simple way. Also, I'm going to walk you through the first steps to start recording your transactions the right way. So don't miss it. Hit the subscribe button so you can also practice with the exercises I'll be posting for each video. See you next time in this channel. Thank you and see you soon.